thank you, everybody, for being here today, seeing lots of people that have come to these meetings year after year, and we just really appreciate your attendance and participation, and I hope that we're all doing a good job of providing you useful perspectives. Sometimes that perspective is more fun than others, so we'll see where it goes today. My job this morning is to try to lead you through a thought process to reach a conclusion about this issue. Everybody knows that prices have been much lower recently than during the boom years. I don't know of any more strategic question of whether these prices in recent years, are they the new normal? Or is there a chance that will revert back up towards the better times and much higher prices that we saw, say, starting in 2007? Fundamental question. And so going to try to give you, hopefully, a framework to think about that maybe from some different perspectives. Okay. Where I'm going to start is a review of what Daryl and I called our new era of grain prices analysis that we put together in 2007 and early 2008. And we have written a number of articles on FarmDoc Daily about this, publications, and we've talked about it a lot in the past and at these meetings as well. So I'll do a quick review. So the question, as you look at the chart in front of you, you see the first spike in corn prices here, and back up. This is the monthly average farm price of corn in Illinois, going all the way back to January 47 through September 2018. And look at that first spike in 2007. That's what Daryl and I were wrestling with. Well, was that a temporary spike that would mean we're going back to era number 2 prices? Or did it signal another step up in average nominal prices? So that's what we were wrestling with, and here's the conclusion that we came up with. Again, remember, we're always talking about nominal corn prices in this chart and later soybeans. We're not adjusting for inflation for this particular analysis. We believed that corn prices were moving into a new era of higher average prices, powered principally by the ethanol boom. But of course, the key is how much higher? That's always the key question. So the way we looked at it, we were seeing 3 eras. You look on the chart, era number 1 from 47 to 72 had an average price of $1.28. That's era number 1. Era number 2 from 73 to 2006 had an average price of $2.43. We said the jump between era 1 and era 2 was about 90% increase in average prices. What if the new era is similar? And that is exactly how we came up with our really complicated forecast of the average price in the new era of $4.60 a bushel. It's proportionately the same jump between eras 2 and 3 as between eras 1 and 2. Pretty straightforward. That's how we made our original new era forecast. And it's important to remember, we were really sticking our necks out there because we weren't very far into this new era. We were making that forecast in 2007 and 2008. And so there was obviously a lot of people who disagreed with us, thought we'd go back to the old price levels. How could you make that kind of forecast? Of course, we know that long-run prices are very volatile. And so we put a range on corn prices between $6.70 and $3. We did that based on the volatility of prices in era number 2. The specifics aren't important here. Turns out that bounded the price range very nicely for corn. And you can see our recent prices have been definitely running along the bottom of our new era projected price range. Because we thought that era number 3 was powered by the ethanol boom, so it was a corn boom in terms of nominal prices, we decided to project long-run average soybean prices relative to that corn forecast of $4.60. That's how we did it. Era number 2, for your information, was more of a soybean-led boom. And so we just took a long-run average price ratio between soybeans and corn of 2.4 to 1, multiply that by 460, gives us a price of $11.04. And then a range of a super high price of $18.33 at the high, a low of $7.84. And once again, particularly recently, we're scraping along the bottom of our forecast new era price ranges. So remembering that we made these forecasts in late 2007, first half of 2008, here we are over 10 years later. How did we do? In the 12 years of this new era, era number 3, the monthly average price of corn for those 12 years was $4.43. $4.43. It's not bad, only 17 cents off. So thought we did pretty well with our corn price forecast, just a little bit low for a 12-year time frame. Here's soybeans. That's just dumb luck. I'm not really even going to take credit for that. I know I will never make another long-term forecast as good as this one. So that's just a quick review of our original new era forecast for corn price and soybean prices. But what we want to know is the answer to a different question, not necessarily, okay, what's going to be the average for this entire, long period, but standing here today, what will be a good price for corn and soybeans maybe out the next 10 or 15 years? That's what we need to know today. And there's a pattern that, if you do a careful anatomy of the previous eras, that I think is very powerful in helping us build a framework for thinking about answering that question. And the first glimpses of that pattern are seen in the current era. Because you see the average for the first 8 years of the current era was $4.90. Just think about that for a minute. No wonder things were so good for so long. The average price of corn in Illinois for almost 8 years, now obviously there's huge volatility, but we averaged almost $5 a bushel. Those are some good times. In the last 4 years, after the party subsided, the average is $3.57, okay? So well over a dollar a bushel lower. That's a big difference. Similar story in soybeans. The first 8 years of this new era, we averaged 11.73. The last 4 years, 9.75, $2 lower. Now, just as a side note, Darrell and I kind of humor ourselves with this. If we go back to the corn, when we were the first 8 years of this era, notice at 460, which was a really high price forecast, we were actually too low by 30 cents a bushel. And of course, the 460 has been way too high, a dollar too high in the last 4 years. Similar story in soybeans. So what we're going to do next is we're going to step back and do a little bit of digging and history into the old eras, eras 1 and 2, and I'm going to show you a pattern that I think, again, is helpful and powerful for thinking about the future. So this chart shows corn prices in Illinois, monthly average again, nominal, not adjusting for inflation, only for era 1. So this is the pattern of prices from January 47 through December 72. Okay, I'm not going to ask anybody if they were farming during era number 1. There might be. The first phase of the era is what I'm calling the demand shock phase. That's to the left of that vertical black line. And in era number 1, the demand shock came in the form of the Marshall Plan after World War II to feed Europe and the Korean War. And that gave us the first boom post-World War II. And within that boom period, which turned out to be roughly 8 years, these things are never dated precisely, what happened? Prices jumped, really skyrocketed, acreage expands, there's an investment boom in the sector, and the final stage, we bid up the whole cost structure. Cash rents, machinery values, land values, the whole thing. That's what happens in what I call the demand shock phase of the era. Then we enter a much longer period, a couple decades at least, where essentially what happens as a result of that demand boom phase is the pattern is for supply to outrun demand, because productivity growth is increasing faster than demand. So I'm not saying demand doesn't grow during these periods. It's just being outpaced by growth in supply, principally from technology in terms of plant breeding, management changes, improvement in technology in general. What happens when supply outruns demand? We all know the answer. Price goes down. And it went down a lot in era number 1. I mean, the nominal price levels are obviously much lower, but notice in those early boom years of the late 40s and early 50s, the average corn price in Illinois was $1.57. The next couple of decades, it averaged $1.15, and it was clearly on a downtrend, wasn't it? So that's the pattern in the market in era 1 that I want you to see. But there's one more aspect of the pattern that's absolutely key, and I don't think we're talking enough about if this pattern is a legitimate description of what happens in every era. The blue line far from represents a free market price, because we had massive intervention by the federal government from, we'll walk through, two different perspectives or two different methods, all in an effort to put a pretty high floor under the market price. And the way I help you visualize that, I add to this chart, take away a few other things, and then include the national average CCC loan rate, which it's not strictly speaking true, but I call that a floor price. Effectively, we were trying to floor the market price at that red line. And there's a really interesting pattern here. You see, in the boom years, we raised the minimum, tried to follow up the price. And then we got a lot of production. And notice that the red line is actually well above the blue line for much of the 50s. And what do you think happens when the red line's a lot above the blue line? What is that telling us? Anybody remember? Huge surpluses. Because what is going on is the government is supporting the price of corn by basically buying it and storing it and keeping it off the market for a long period of time. We had all sorts of storage programs in the 50s. I'll bet some of you are still filling up those 3,000 and 5,000 bushel bins that were built in the 50s. They're a huge pain to use, aren't they? We had a bunch of them on my farm back in Iowa. Hated those things. They were hot in July. Well, that got really expensive because we had literally mountains of corn we were storing. So the government in the late 50s and early 60s turned to the other main tool for trying to floor the market. Anybody got any guesses what that would be? Yep, we called it set-aside supply control more generally because we had something called the soil bank, and then we had annual set-asides. And it's really easy to forget how big those annual set-asides were. Routinely, generally, 20% of base acreage, sometimes as big as 40%. And that varied depending on the need to floor the market. So that's a key part of era number one was government intervention to try to floor the market. Okay? Keep all that in mind. Now we're going to go through era number two, and we're going to go a little faster. The boom was roughly 73 through 76, and I'll really date myself. That's how I got so fascinated with commodity markets. That's right when I was in high school. And I thought, wow, farming is great. You make tons of money in farming. If I'd only known the pattern. Okay. And so the demand shock phase of era number two, which we date from January 73 through November 2006, so roughly 73 through 2006, it was a grain export boom, much of it to the ex-Soviet Union. Inflation, oil price boom was going on. Intriguingly, for the huge impression it left on me as a youth, this boom was really pretty short. It really only lasted 4 years. But what a wild ride it was. But the same thing. Prices jump, acreage expands, investment boom in agriculture, cost structure gets bid up. And then we go to phase two, supply outrunning demand, and a long, slow grind down in the average price of corn in Illinois. Now, it wasn't nearly as severe as in era number one. The average price of corn in Illinois in the demand shock boom phase was $261. On average, for the next couple decades, it was $241. Now, I explain that as post-World War II was just simply an incredible period of applying modern science to agriculture And there was, relatively speaking, more low-hanging fruit in terms of technology. But still a lot of technological improvements in this era as well, just not as fast, excuse me, as in the 50s and 60s. But the pattern holds, doesn't it? Then the last aspect. Are those prices you're seeing on the chart true free market prices? Did we let price drop as low as it might have? No. Now, I know a lot of you were farming during these years. Here's what the CCC loan rate for corn looked like. And this is really interesting. It's amazing how similar the story was. Loan rate during the boom years was stuck at the era #1 level. And then look how we marched that loan rate up. Easy to forget, in the mid-'80s, the loan rate was over 250. Does anybody remember what ending stocks for corn were like, say, in 1985 or 1986, as a percent of usage? Probably only market nerds like Todd Hubbs and myself know this. About 2/3 of usage. If you think soybean stocks are now large, go back and look at corn stocks in the mid-'80s. Huge stocks of corn built up by those high minimums, encouraging production, because we wanted to put a high floor into the market. So, gosh, what did we do? Well, we got to lower those loan rates so the government doesn't own as many stocks of grain. And we go back to set-asides. Thank you. And in 1985, we created something called CRP. Put 36 million acres in there and went back to very aggressive set-asides until the 1996 Farm Bill. Same, it's like the same movie on the same TV channel with the same two phases and the same reaction in terms of government farm bill-related policy. That's era #2. You see the pattern? Okay. Now we're going to apply that framework to thinking about the current era that we're in. We don't know how long it will last. There's nothing magical that they say they all have to be 30 years. Who knows? But look at how well that framework fits our current era. From 2007 through roughly mid-2014, again, the dating of these things is not exact, we had the demand shock phase. And I call that the ethanol boom. Stir in a little bit of weather problems, particularly in 10, 11, and big one in 12. You combine those, and you got really high prices. But once again, what happened? And all of you have lived through this. Prices jump, acreage expands, investment boom in agriculture. Anybody here buy any new machinery in the last 10 years? I'm just taking a guess. Cash rents maybe gone up during this period? Anybody notice that? Once again, the cost structure gets bid up. And so my argument is, starting in about 2000, sometime in 13 or 14, we started to enter phase 2 of the era, where supply growth tends, and again, it's a tendency, it doesn't hold every year, every month, to outpace growth in demand. I mean, we've seen this play out in ethanol. That has really plateaued. It's growing, but at a much slower rate. We already know the numbers, but I'll put them back up there again. The average price of corn was $4.90 in the demand shock boom years, 3.57 cents. So I think the framework is useful. But here's one thing that we all need to be thinking about that is dramatically different in era 3 compared to era 1 and 2. Where's the floor? It's at $2 on corn, and it was $2.20. I'm not saying we're going back there, but at least so far, one thing that distinguishes this era from previous eras is there has not been a policy response to put a firm market floor in the same direct way as we did in era 1 and 2. Here's the way I put it. If we were following the policy pattern of era 1 and 2 and era 3, loan rates in the last farm bill would have been raised to someplace between 3 and 3.50. And we would have on the books large acreage set-aside programs. Now, you have to keep some balance in this. It's not like we don't have government programs going forward. You know, we just passed a new farm bill, and in particular PLC, as the demonstration of the tool showed, will give some downside price protection. We do have a loan rate program way down there. We still have a CRP. It was at 24 million, and now the cap's raised to 27 million. So that's still going on. And we still have the RFS with all its controversies on the demand side, help give it some flooring in the market. But the big picture, when you balance this out, that I want you to see, is that in our current era, compared to our previous eras, we're operating without a net under the market. Now you say, well, whoa, wait a minute. We have crop insurance. And it is heavily subsidized, and it is a form of a risk management tool. But remember, as you've just experienced the last 4 years, the protection level ratchets down over time with the market price. The Farm Bill programs we had in era 1 and 2, high CCC loan rates and set-asides, are all designed to get the market price up, okay? Not manage risk within a year given market prices. That's what crop insurance does. It's not the same. So that's, to me, the one big change as we look forward. I don't see any political support for going back to the same kind of direct market intervention in terms of holding huge stocks of grain and or large annual set-asides to manage the market surplus. I don't see that. And so that's a big change from where we were in the past. Similar story in soybeans, so we'll just jump ahead. So with all that as background, my assignment was to give you guys a number. Now, unfortunately, I was not at that meeting when I got that assignment. It was apparently why I got the assignment. So one way that I could approach giving you a number was to just take the last 4 years, say we're into phase 2, and we've got a gently drifting down price path. We're just going to keep grinding lower. That's what you do in phase 2. And that would then give you a planning price of somewhere around $3.35, given recent projections. But because I'm an optimist and I believe in droughts, by the way, all week I've been listening to Todd Hubbs and others say how we need a drought in Iowa next summer to help us out. I grew up very close to my grandmother, and we farmed with my grandfather and grandmother on my dad's side of the family. And I grew up out in Iowa, you know, always told to pray for a drought in Illinois. Now, I have to be careful with that, you know, knowing where my paycheck comes from, but just a little equal time there for Iowa versus Illinois. But in seriousness, I believe this is too pessimistic. Who can doubt that we've had really good weather, and that's been talked about several times already today. I mean, this has been unusually good weather. Here in the Corn Belt, we have Corn Belt-wide drought events, typically 1 out of 8, 1 out of 9 years. That's the long-run frequency. We've really had 1 or 2 in the last 22 years. So I'm not saying we're due, but we're due. And we are going to have those kind of 2012 or maybe smaller 1983-style droughts. I'm firmly convinced that climate change has not eliminated droughts. For perspective, in 2018, the state average yield of corn in Illinois is going to be someplace around 210 bushels an acre. Phenomenal year, right? 6 years ago, in 2012, I mean, things aren't that different. Anybody remember what was the state average yield in Illinois? How easy we forget. It's right at 100 bushels an acre. State average. Torched the place. If it doesn't rain, we are still going to have some big droughts, and we will have high corn prices. And so when I put in my magic black box this idea that we're in phase 2, so the general tendency is a slow grind down in the nominal price of corn, but we're going to have that interspersed with some occasional periods of high prices due to weather problems. I come up with the new era of prices, as Todd likes to say, or phase 2 projections of an average price of corn on a monthly average basis here in Illinois of $3.75. Okay, $3.75. Probably if you want to look out 15 years, that'll be a little too high because the tendency is to grind a little lower. Again, we will have high prices during certain time periods when we have weather problems. That's why in the past, when we have those, we tend to go up around 50% on a monthly average basis. Of course, futures on a given day in the middle of it will be even higher. So the high on the price I put is $5.50 for the high in the range. The low is $2.90. So a couple things to take away from this that I think are important. One, we're still going to be in a new era. We are not going back to 240 corn, at least with the policy and market structure we have now. Okay? Things obviously can change. I hope things don't get that bad in the future at any point. That's on the downside. On the upside, it's hard for me to see a set of market circumstances now that will put us back to $7 or $8 corn. So those highs are probably behind us for quite some time. And that's the range that I forecast. What about soybeans? Really struggled with this. You know, you got almost 1 billion bushel carryout and the trade problems. It's really hard to kind of get your mind straight. So I fell back on what we did in our original work, and I said, I feel pretty good about the 375 on corn. I'm going to use the same price ratio that I used previously, 2.4 to 1 for soybeans to corn, and that gives me $9 soybeans. A high of 13, low of $7 per bushel. And so I gave you numbers. That's my story, Todd, and I'm going to stick with it at least till next year.
Good reason for them to come back next year. Give him a nice hand.